I took $1,000 from my savings account, $10,000 from my emergency fund, and $100,000 from my retirement portfolio and put all of it into a single investment, the Schwab Dividend ETF, SCHD. What happened next? Shocked even me. The $100,000 investment now generates more passive income each month than some of my friends make at their part-time jobs. And that's without touching a single dollar of my principal. Today, I'm going to show you the uncensored results of all three investments. No theory, no projections, just real numbers. And when you see what happened to the reinvested dividends alone, it might completely change how you look at building wealth. While everyone else was chasing the latest crypto or meme stock, this boring dividend ETF was silently making me richer every single quarter. I'll be sharing the clear results of my investments of $1,000, $10,000, and $100,000 into the Schwab U.S. Dividend Equity ETF, also called SCHD. You'll see not just the total returns, but more importantly, how the dividend income grew at each level. This creates a cash flow snowball that few investments can match. By the end, you'll understand why Warren Buffett's saying, "If you don't find a way to make money while you sleep, you will work until you die," might apply perfectly to SCHD. I wish someone had shown me these numbers years ago. It would have sped up my journey to financial independence. Before I share my results, let's talk about what makes SCHD stand out among ETFs. The Schwab U.S. Dividend Equity ETF tracks the Dow Jones U.S. Dividend 100 Index, focusing on quality, dividend-paying companies with strong finances and steady dividend growth. What sets SCHD apart from other dividend ETFs is not just its impressive 3.5% yield, which is more than double the average of the S&P 500. It also has a low expense ratio of just 0.06%. This means if you invest $10,000, you're only paying $6 a year in fees, compared to other funds that can charge $75 or more annually. But here's the key point. SCHD doesn't just pay dividends, it increases them. Over the last 10 years, SCHD's dividend has risen by an average of 10.5% each year. This means that while other fixed income sources lose value due to inflation, SCHD's dividends effectively double every 7 years. The ETF has only 100 stocks, unlike many broader index funds that have hundreds or thousands. Every company must meet strict criteria, like paying dividends for over 10 years and having a strong cash flow. This means you're investing in well-established companies like Coca-Cola, Home Depot, and Pfizer, which are strong enough to handle tough economic times while still rewarding their shareholders. Let's start with the smallest amount, $1,000. This is often where many people start, maybe with a bonus or tax refund. I had pretty modest expectations when I invested this amount in SCHD, but I was wrong. In the first year, that $1,000 earned $35 in dividends. It wasn't life-changing, but it was already 3.5 times more than a high-yield savings account would give me. By the second year, my annual income jumped to $38.50. By the third year, it rose to $42.35. What surprised me even more was the total return. That initial $1,000 grew to $1,324 in 3 years, a 32.4% increase during a time of significant market ups and downs. An impressive $120.85 of that came purely from reinvested dividends, showing how powerful compounding can be. For someone investing just $1,000, this is significant. Even small investments in SCHD can lead to real results over time. It's a great starting point for new investors or for those with limited capital. Let's look at a $10,000 investment where dividend income starts to make a real impact on your finances. In the first year, my $10,000 in SCHD generated $350 in dividends, almost $30 a month. By the second year, this increased to $385, and in the third year, it reached $423.50 annually, all without adding more money. The power of compounding becomes clear here. My original $10,000 grew to $13,240, resulting in a gain of $3,240. Out of that growth, $1,208.50 came just from dividends, which bought me more shares. Those new shares then earned more dividends, creating a snowball effect that picked up speed over time. Many investors overlook this. At the $10,000 level, SCHD's increasing dividends start to have real benefits. That $423.50 in annual dividends could pay for a monthly streaming service, a phone bill, or a few grocery trips throughout the year. While it's not financial independence yet, it's a solid step toward making your money work for you. Now let's talk about the $100,000 investment. This is where I really began to see the true power of SCHD. In the first year, my $100,000 SCHD investment brought in $3,500 in dividends, about $300 each month. By the second year, the dividends grew to $3,850 annually, and by year 3, they reached $4,235, which is over $350 a month without touching the principal. The total investment increased to $132,400, giving me a gain of $32,400 in just 3 years. Out of that, $12,085 came from dividends that bought more shares. In year 3, those quarterly dividends became substantial enough to positively impact my finances. To put it in perspective, $4,235 in annual dividends could cover your 6 months' worth of car payments, or several utility bills for a whole year, or a nice vacation fully funded by your investments. Or, if reinvested, you could purchase around 70 additional SCHD shares each year at current prices, boosting your income even more. This is where dividend investing starts to offer real financial freedom. If you keep scaling or let it compound for longer, it could potentially replace your job income entirely. So, why choose SCHD among all the dividend ETFs out there? There are 3 main reasons SCHD stands out. First, it strikes a balance. Unlike many high-yield ETFs that sacrifice growth for income, SCHD offers both. For example, ETFs like JEPI might have higher current yields of 8 to 9%, but they don't have SCHD's growth element. My $100,000 SCHD investment not only earned $12,085 in dividends, but also increased by $20,315 in share price. That combo of income and growth is rare among dividend ETFs. Second, it focuses on quality. SCHD uses strict criteria for selecting stocks based on dividend growth, not just high current yields. This method weeds out companies with unsustainable dividends or fundamental issues. By insisting on companies with at least 10 years of growing dividends, SCHD picks firms with solid business models and management that cares about shareholders. Third, it offers consistency. SCHD has shown steady performance, even during market downturns, the pandemic, and inflation worries. In the 2022 market drop, SCHD dropped less than the overall market, while still paying and growing its dividends. This reliability helps you stay invested during tough times, which is when compounding really shines. So, what does this mean for you, practically speaking? If you're starting with $1,000, don't be discouraged by the seemingly small dividends. Set up an automatic investment plan. Even $100 monthly contributions will significantly accelerate your results. The key is consistency. With $10,000, SCHD can be a cornerstone of your portfolio. At this level, reinvesting all dividends makes the most sense to maximize compounding, unless you need the income right away. And if you're fortunate enough to have $100,000 to invest, SCHD can be a significant part of your retirement or financial independence strategy. You might reinvest all dividends to maximize growth, or use some dividend income for current expenses while reinvesting the rest. The most powerful takeaway from my experiment is understanding SCHD's potential over the long term. With its historical dividend growth rate of approximately 10.5% annually, $100,000 investment today could potentially generate over $9,000 in annual dividends within just 10 years, without adding another penny. This understanding can transform your approach to investing. If you thought my $100,000 SCHD investment results were impressive, you need to see how you can just invest $25 per week to generate $5,000 in monthly passive income without touching his principal. Click the video on your screen now to discover.